Hello, welcome to the Retire While You Work podcast. I'm Myles Zuger, a wealth advisor here on the team, joined by Jeri Anne, our director of operations, and Carson Odom, another wealth advisor here on the team. It's been a couple weeks since we've done the podcast with the start of the holiday season. It's been a little busy around here, so we're excited to be back on here today and getting back into our rhythm of holding these podcasts here. I know we've gotten some good feedback on topics we covered and discussed, and just from clients, just that they've really been enjoying these. So we're excited to be back doing this. Welcome back, guys.
Appreciate it. It was uneventful for Thanksgiving for my family. We had sickness, so we had to miss all of our family gatherings. But I feel like every other person I talked to had some sort of cold or cough or something going around. So it wasn't a fun Thanksgiving for us, unfortunately.
Yeah, I feel like there's definitely something going around.
Well, good. Well, we got redemption for Christmas coming up, so
it's crazy. It's a couple weeks out.
Yeah, I know.
It just goes back quicker every year, don't it?
I'm done with all my Christmas shopping.
There you go.
I think we are too. I think Rachel still has her parents to purchase, but it's her issue.
We'll tell them you said that. Yeah, today we're going to be discussing 3 buckets. I think we've maybe covered this before, but it's something we like to kind of bring back to the top every now and then. It's one of the core planning elements to our practice here, something we use with every client, regardless of if they have $5,000 or $5 million plus. I think it makes financial planning simple, helps people feel like they have a good plan in place, and it's easy for them to understand. And we've had a lot of success using this in our practice. And so, again, we just like to kind of bring it back to the top every now and then, whether you're a client or maybe somebody new listening for the first time, just so you can have a good refresher or kind of learn what we're all about. So, Carson, you want to kick it off with bucket 1 and what that means to somebody's financial plan and how they should think about that?
Of course. Yeah. I think for any financial plan, again, no matter what stage of life that you're at, bucket 1 is foundationally the most important. Every good financial plan starts with having the right amount of money in cash. So bucket 1 is an emergency fund, basically anywhere from 3 to 12 months worth of living expenses in your bucket 1. It varies person to person. If you've got a really secure job, you got great cash flow coming in, maybe you can lean closer to that 3 months worth of living expenses. If your income can be sporadic, you can have great years, you can have smaller, slower years, then maybe lean closer to the 12 months worth of living expenses.
Carson, is that also to include anything that like big expenses coming up? Should they have that in their taxes, that kind of thing?
For sure. Any big expenses like taxes, if you're going to be buying a car in the next few months, whatever the case may be, it's 3 to 12 months worth of living expenses plus any big expenses coming up. So treat bucket 1 as cash in the bank. You need immediate access to it, and you don't want to be taking any amount of risk with that cash. So think of a money market account, high yield savings account. In this day and age, make sure it's making 3 or 4% interest. The purpose of it is safety and in case of emergency. The purpose of it is not to grow your wealth and grow your balance sheet over the long term. So make sure that before you really focus on buckets 2 and bucket 3, make sure that you've got enough cash in the bank in bucket 1. So anything I missed? Anything else?
No, yeah, that's great.
Where would you say, is that just a savings account or like a money market account? When you think about bucket 1, where should people be holding that at?
Definitely. I always work off of 2 bank accounts, a checking account and some form of a savings account. It can be a money market, high yield savings account, whatever the case may be. Checking account is where your paychecks go. It's what you operate out of. It's what you pay your bills out of. Then have a separate account that you treat as savings, and you generally don't touch that money. Even if you start with $100, everybody starts somewhere. Everybody makes their first little bit of income. Everybody starts somewhere. Make a savings account that you can visually see and visibly make transfers into, and you can view that money is set aside for a different purpose. And you can gain traction. You can set up automatic transfers to go into that savings account. But most importantly, is that money is accessible so that in the event of emergency, you've got, you run over some screws in the road, you got to buy 4 new tires, you got to drop $1,000. Instead of going backwards into credit card debt, you can transfer $1,000 out of your savings account into your checking account, pay cash, and then focus on getting that savings account built back up. When I mention 3 to 12 months worth of living expenses, if you reflect, and we've talked about this many times on the podcast, in order to even know how much you should have in your emergency fund, you have to know how much you spend on a monthly basis or have some general idea of what it takes to live. So that also screams the importance of tracking your expenses to some degree. But reflect on your expenses, understand that if you lost all sources of income and you just had to make ends meet for a month, what would it take to live? So imagine yourself there where you don't have a job, you're just making ends meet. You don't have a 401k you're going to be contributing to anymore. You're probably not going to be building a bunch of travel into your budget. It's just food, groceries, bills, that sort of thing. If it takes you $5,000 to live, okay, multiply that by 6 if you want 6 months worth of living expenses. 30 grand, that should be your target to have in a savings account.
Yep. And I think, to your point, 3 is definitely the low side. I think 6 months probably best for everybody, especially, we saw during COVID, a lot of our clients who are maybe musicians or other professions that were just totally out of work for the better part of 6 to 18 months, depending on kind of what they had going on. That emergency fund was a very important piece of their plans. I think 3 months certainly on the low side, maybe if there's 2 incomes in the house, but if there's just 1 income in the house, probably closer to that 6 to 12 month range, in addition to what we said, any other big expenses. And I just think it's important to, maybe 3 or 4 years ago, it didn't really matter what kind of interest rate you were getting on that account. But, at one point here recently, savings accounts were up, maybe 4.5%, 5%, and they're still maybe, around 4%. So try and get as much yield as you can, but just make sure that it's safe and has some sort of maybe FDIC insurance on that account with those limits in place. I think that makes sense. So try and maximize that the best you can, but just know that's not the piece of the plan where you're going to be getting rich making 10+%.
Yep. And really just one last thing on bucket 1, the reason it is so foundational and so important is because the whole idea with investing in a financial plan and growing assets in the stock market is you don't ever want to have to be in a position where you have to sell stocks while they're down or pull money out of a retirement account and pay penalties on that account. And you do that by always making sure you have enough cash in the event of emergencies. The reason that people can ruin a financial plan basically is by not having enough cash in bucket 1, and you end up having to pull from retirement accounts or other investment accounts. And it's likely a time whenever the economy's not so great, people are losing their jobs, stock market's probably down. So then you're stuck at a point where you've got to tap into a retirement account, the stock market's down, you're selling stocks while they're down, you're paying penalties, you're paying taxes. So all of a sudden, what was once $1 million could have fallen to 600-700. Then you pay 30% taxes, 10% penalty, and all of a sudden, what was once $1 million is now $400,000 worth of value. So the whole idea of bucket 1 is making sure that you can let your investments ride in the event of turmoil, that you have enough cash to rely on.
Yeah, I think that's well said.
Yep.
And then bucket 1, we skip over bucket 2, hop over to bucket 3.
I'll talk about bucket 3 if you want, and I'll leave bucket 2 to you, Myles.
Yeah, go for it.
So bucket 3 is your retirement accounts. This is anything that, it's a 401k, a traditional IRA, Roth IRA, a SEP IRA, anything that is in that retirement bucket that you can't touch until you're 59 and a half without paying a penalty. You're not required to touch it until, is it 75 now?
73.
73
currently,
still?
and
Okay.
2033, that RMD age which stands for required minimum distribution, is jumping up to 75.
But this is, 401k, what you have through your employer. Ideally, as you grow that or add to that each year, you would want to eventually try to max it out and get the most out of that as you can. That's your longest, amount of money that's out there to grow. And it's going to be your probably your biggest return too, because it's going to be more aggressive, invested more aggressively because you can't touch it for so long. Even with young people starting out with 401ks, what I always tell my daughters, for instance, is every year when you get paid, up the percentage that you're putting into your 401k. I mean, every year when you get a raise, up the percentage that you're paying into that 401k. So eventually you're going to be maxing it out and not even notice. But yeah, what else did I miss on that bucket?
I would just add, for somebody with like a a W-2 job, for instance, 401k, for example, is going to be one of, if not the best dollar for dollar tax deduction that you have available. If you're doing the traditional option, if you're maxing it out and you're under 50, you're putting about $23,000 in there. If you're over 50, you're able to do an extra 7,500, I think, with current amounts. So you're able to do, around 30,000. So if you just have a W-2 job, that's $30,000 of income that you can save into a retirement plan, get that invested for the long term, as well as get that tax deduction, which can be pretty nice if you're in one of the higher tax brackets.
And the other thing I just wanted to mention about that bucket is there's a SEP IRA is included in that, and that's if you're a 1099 employee, you can open a SEP IRA. That's the amount you can put in is based on how much you make that year. Your accountant can help you with that. But a lot of people don't realize that if they don't have access to that 401k, that there is another retirement vehicle, which is called a SEP IRA.
That's right. There's also solo 401ks, simple IRAs. I mean, there's a pretty 403bs. I mean, there's a pretty long list of retirement plans. But the idea with bucket three is, how you invest money is generally associated with time horizon. So bucket three, like you mentioned, Jeri Anne, is the longest time horizon. You've got until, if you're in your 20s or 30s, you've got until you're 60 plus years old before you're going to be touching this account. Since the time horizon is so long, generally your aggressiveness with how that money is invested can also be pretty aggressive, can be a majority of equities. As opposed to, again, what I talked about, bucket one, you could need that money tomorrow. Therefore, your aggressiveness is going to be as conservative as you can be, which the most conservative you can get is cash.
Yeah, great.
Yep. Yeah, I think that makes sense. So that's kind of bucket one, bucket three. So we got short term, meant for emergencies and upcoming expenses. You've got bucket three, retirement accounts, long term there, and I'll cover bucket two. So then you hop over into the middle, into bucket two, and this is where David's kind of coined this, the retire while you work bucket. It's really that in between plan. So you don't want to have too much in cash, not doing a whole lot. You don't want to be putting everything into your retirement plan because you can't touch that to your 59 and a half without penalty outside of some certain circumstances. But you're always going to, for the most part, going to be paying taxes when you're pulling money out of there. So then, maybe you're somebody who's doing everything you can, retirement plans, you've got plenty in cash, and you say, hey, well, what else can I be doing? I want to continue saving, building up my investment plan for the long term. So that's where bucket two comes into play. And what bucket two is just a standard brokerage account. Could be individually held in your name, could be jointly held with a spouse. But this allows you to put money in there, get it growing, invested in stocks, bonds, combination of the two. And it's much more tax efficient because you're only paying capital gains rate, which currently are at a max of about 20%. So it's just that piece of the plan that maybe, again, you're doing everything you can from the retirement perspective, but want to save more. Or maybe it's, you're trying to save for the down payment on a house, but it's not something you're doing in the next couple of years. Maybe that's a 3, 4, 5-year project. So it's a place that you can save, hopefully get a little bit better return than what you're able to in cash. And then when the time comes, you can pull that money out for a down payment or whatever that expense might be. So it just helps to provide flexibility to a plan where you're hopefully earning more in cash, not locking it up into retirement. And it can be a nice piece for, various expenses or long-term savings also. Carson, I think you were going to say something.
Mention of your emergency fund if you needed it,
Yeah, I think that's the other big piece is it's fully liquid to you as an investor. So if you, to Jeri Anne's point, spent through your emergency fund because you were without a job or just some big expense popped up, you're able to dip into there, again, only pay capital gains on the growth inside of that account and get money out to help you continue to cover expenses or replenish your emergency fund if needed.
Kind of in that same conversation, but on the opposite end, it could be a pretty aggressive account because your time horizon might not be till you're, if you're young, till you're 55. Maybe your plan is to just retire and just a little bit before 59 and a half. So, imagine you don't want to be caught in two extremes. Like you said, Myles, you don't want to just shove money in bucket one where it's just making 3-4% interest because you're not getting a very good rate of return over the long term. You don't necessarily want to only focus on contributing to bucket three because then you literally can't touch it until you're 59 and a half without paying taxes and penalties. So then where you end up viewing it as, okay, if I retire at 55, how am I going to bridge that gap from 55 until 59 and a half? And it's bucket two. That's how you bridge that gap. And if you're young, then your bucket 2 could be generally pretty aggressive because you've got, again, it's all based on time horizon. You've got 10, 20 plus years before you're going to need to touch this money. But like you said, Myles, if you've got a plan to, buy a rental property in 5 years, or finish off your mortgage in 5 years, whatever the circumstance may be, if your time horizon for a bucket 2 generally shorter, then you could be a little bit more conservative with how you invest that money.
And the great thing about bucket 2 also is you can have both of that. You can have multiple accounts. You can have one that's earmarked for, I'm going to save up for a house over the next 3 or 4 years, and it could be invested a certain way. And then you could have another account that's like, no, I'm not going to touch this until I retire type of thing. And it can be invested more aggressively. So
yeah, that's right. And I think what we typically see is bucket 2 really ends up being the largest bucket for most people, because you don't want to, like I said, you don't want too much money in bucket 1. Once you get that 3 to 12 months worth of expenses, it's funded. Then bucket 3, it's technically capped. You only put $23,000 a year unless you're above 50. Then there's a catch-up contribution. So if you have extra savings, where do you put it? Just funnel it into bucket 2.
Yep. Yeah. And I think sometimes we get the question from people too, how does real estate maybe fit into the 3 buckets? And that really is a bucket 2 type of investment. It's just kind of below the line because it's not like a stock or a bond where you can click a button, sell it, have liquidity in the next day or two, and that money in your account. There's a little bit of a longer process there, but when we're planning with clients, it is a piece of the plan that we certainly want to take into account, because hopefully there's some appreciation on those assets, on that asset. Hopefully there's some income if it's a rental property coming in from that. And so it's certainly a piece of the plan, kind of like in a liquid piece to the bucket 2, because there's time. It takes time when selling real estate, but when you're looking at the 3 buckets, that is where it fits. It's just not, again, not a liquid piece that you can have access to in a couple of days. There's more of a process there.
It really is that simple. Again, like Myles said, no matter if you're just starting out with your first job out of college, or if you're, in your 60s and approaching or already retired, everything can still fall into the 3 buckets. And if we had a whiteboard, in front of us in our conference room, we'd put it up where it's still just buckets 1, 2, and 3. We've written, the 3 buckets on our whiteboard in our conference room thousands of times, and it's just different numbers for different people. That's all it is. It's a very simple way to think about your personal financial plan, but there obviously can be added complexity to anyone and everyone, depending on their personal financial situation. But that's it for the most part. Pretty easy.
Yeah. Real quick, what bucket do each of you think is most important to the plan, and why?
I said this at the beginning.
Say it again.
Bucket 1. I personally like. Gosh, that's tough. I really like bucket 2. I like having the freedom to do whatever I want with that money if I need it, or I can let it grow forever.
Yeah, I think it's definitely it is tough. I think it's 1 or 2. I think 1's the easy answer because most people, if they have plenty of cash in the bank, they just feel good about things. We call it Carson. Kind of recap. Carson said 3 to 12 months, but sometimes people just have we call it the sleep at night number, where if they don't have X amount in their bucket 1, they're stressed out and they're not sleeping well at night. So I think bucket 1 can provide a lot of peace of mind to a plan. But to Jeri Anne's point, I think it's maybe bucket 2 because that can kind of be an emergency fund to an extent, and hopefully earning a little bit more than in cash.
Yes, most fun, exciting bucket 2, most important bucket 1. Stand on that, die on that hill.
All right. Well, thanks for joining us today. Hopefully us kind of running through the 3 buckets, recapping this again, whether it was the first time you heard about it or, the 10th time you heard about it, hopefully maybe you pick something up or it helped you to, in your head, maybe simplify your own financial plan. But thanks for joining us, and we look forward to seeing you guys next time.
Thank you.
Thanks.
Any opinions are those of myself and not necessarily those of Raymond James. Expressions of opinion are as of this date and are subject to change without notice. The information contained in these podcasts do not purport to be a complete description of the securities market or developments referred to in this material. The information has been obtained from sources considered to be reliable, but we do not guarantee that the foregoing material is accurate or complete. Every investor's situation is unique, and you should consider your investment goals, risk tolerance, and time horizon before making any investment. Prior to making an investment decision, please consult with your financial advisor about your individual situation. Any hypothetical examples are for illustration purposes only. Actual investor results will vary. Raymond James does not provide legal or tax services. Please discuss these matters with the appropriate professional.